Hey guys, it's Jenny Silver, and today I want to talk to those of you who are self-employed or small business owners about the new rules for the PPP, the Payroll Protection Program, which is the forgivable loan for self-employed individuals and small businesses. Now, if you're self-employed and you filed a Schedule C, the rules have changed regarding how much you can qualify for your PPP loan. Now, previously, if you used a Schedule C to qualify for your PPP loan, the SBA looked at your net income from your Schedule C, line 31. You can now qualify based on your gross income from your Schedule C, which is your line 7 on your Schedule C. Gross income instead of net income. This is a huge amount of money for many individuals, so this may make a big difference for you. It may also mean that if you're previously denied a PPP loan because your net income was either extremely low or you had an operating loss, it means that you now would qualify if you had gross income to claim. That qualifies you. Now, currently the last date to apply for a PPP loan is March 31st. Now, the SBA issued their interim final ruling on this, which is essentially their guidance that states exactly how these changes are to be implemented within the PPP program. The changes take effect immediately, so any lender accepting applications right now will be asking you for your gross income as opposed to your net. You still can use your net if you prefer to do so, but most likely you will want to qualify based on your gross income because it will mean a much larger loan amount. And of course, PPP is a forgivable loan, so as long as you use it as its intended purposes, it can be 100% forgivable. Now, these changes apply to both first draw PPP loans and second draw PPP loans, but as the current language at the SBA stands right now, it only applies if you have not yet had your application approved by the SBA. Now, we may see some developments in this area, and I'm going to create a separate video about what's going on with the challenges of this problem, but currently, as the language stands, it states that they will not make any changes to applications that have already been approved. So that means if you have already applied and been accepted for a PPP-1 or PPP-2, you cannot currently change that prior application to be based on your gross. This is extremely unfortunate for many individuals that have already qualified and been granted the loan that would have qualified for a much greater amount of PPP funding. Those of you that have already applied for and were approved for your PPP loan, whether it's the first or second draw, while you currently can't amend your prior application and can't have it changed to be based on your gross income, we could potentially see a change here. Now, the AICPA, which is the American Institute of CPAs, is being quite aggressive with the SBA and demanding that they make two changes to the PPP program. Number one being that they extend the March 31st deadline, because that deadline does not allow enough time for lenders to be able to update their applications and process all of the applicants through with a reasonable amount of time. In addition to that, they're also being firm and stating that the SBA needs to revise the rule that previously approved applications cannot be recalculated, because it is extremely unfair to those individuals who would have qualified for a significant amount more, but now cannot amend their prior application. So this could change, but at this current point in time, the rules stand that the SBA says that they cannot change a previously accepted application. Previously, the PPP defined payroll costs for individuals who file an IRS form Schedule C as payroll costs plus net profits, which is net earnings from self-employment. This was a problem because it does not take into account fixed and other business expenses that a small business might need to cover in order to stay in operation and therefore keep their owner employed. So therefore, the term income, as used in the definition of payroll costs for sole proprietors and independent contractors, may be construed broadly to encompass a borrower's net income and a borrower's gross income. Gross income is the amount the borrower reports on line 7 of their Schedule C. If a Schedule C filer has no employees, the borrower may elect simply to calculate its loan based on either net profit or gross income. So based on this new rule that you can use gross income, how can you calculate how much of a PPP loan amount you would qualify for? Well, the formula remains the same, only we're going to be using your gross income to calculate it. So that means you're going to look on your 1040 Schedule C. You are going to go to line 7 and find your gross income. Once you see that gross income from the year, you are going to divide it by 12 to get your average monthly gross income. Once you have divided that number by 12 and you have that average monthly amount, you're going to take that average monthly amount and you're going to multiply it times 2.5. Now the maximum gross income that you can use to calculate this is going to be $100,000. So if your line 7 on your Schedule C is greater than $100,000, you will use a top cap of $100,000 only. You must provide the 2019 or 2020, whichever you use to calculate your loan amount, IRS Form 1040 Schedule C with your PPP loan application to substantiate the applied for PPP loan amount, and a 2019 or 2020, whichever you use to calculate, Form 1099 miscellaneous detailing non-employee compensation, bank statements, or book of records that establish that you are self-employed. You must provide a 2020 invoice, bank statement, or book of records to establish you were in operation on or around February 15th, 2020. Now, they have stated here some clarifications of how PPP loan amounts can be used if you use gross income to calculate. For borrowers who use gross income to calculate the loan amount and have no employees, proprietor expenses equal gross income. Now, the first way you can use your funds if you use gross income to calculate would be towards proprietor expenses, which are business expenses plus owner's compensation. Basically, anything that was a deduction on your Schedule C, anything that was a qualifying business expense that was taken out of that gross income on your Schedule C would be a qualifying expense. Mortgage interest payments, business rent payments, business utility payments. Now, you must have claimed or be entitled to claim a deduction for such expenses on your 2019 or 2020 Schedule C. Interest payments, any other debt obligations that were incurred before February 15th, 2020, refinancing an SBA EIDL loan made between January 31st, 2020 and April 3rd, 2020, and covered operations expenditures. Covered operations expenditures, covered property damage costs, and covered supplier costs, in addition to covered worker protection expenditures. Okay, you guys, I hope that was helpful. Please click like, subscribe, and leave me a comment down below.